Markets are in the middle of a generational shift. Investment portfolios that work so well for years may no longer get you the returns you want or the protection you need. So is it time for a new approach? For the last decade, investors could always count on three certainties. First, interest rates going down. Investors could always be comforted of the fact knowing that the central bank was going to drop interest rates at the first sign of trouble. Secondly, globalization, free trade. Politicians were way more apt to say, tear down that wall. And third, volatility. Markets. Markets never went down. Statements were always positive. Today, the environment's changed. Just like the global environment, the financial environment is in a period of enormous change, and most of it due to human causes. Grand distortions in financial markets caused by years of interest rate policy means that the world that we once lived in, we don't live there anymore because they're backing away. And we have to start thinking about how are we going to invest in the environment going forward. The problem is too many investors have an investment portfolio constructed for an environment that no longer exists. We think it is critical at this period in time for investors to stop, take a look, and build an investment portfolio for where we are now. We think the most important thing when it comes to investment is not the one decision that you make, but how you make decisions. With this in mind, we've spent an enormous amount of time encapsulating our thoughts into a set of principles of how we think. And we call these set of principles risk priority management. So let's think about how that impacts how we make decisions on building investment portfolios. Asset allocation. Far too many people have a portfolio built from methodologies designed 80 years ago, which means you have a choice between a 60-40 stock and bond portfolio. Stocks on the one side, fixed income on the other. The world has changed dramatically. Capital markets have changed. The ability to be able to invest in other asset classes today, things like absolute return strategies, private equity and private debt, infrastructure, real estate, power. These are all areas where today investors have access to, just like the pensions and endowments. The second piece is that how do you think about managing risk and returns? Thanks to the incredible development of computing power and using data for analysis, we actually know what's going on inside of portfolios in a much better way today. We think of that as in terms of getting to know its DNA. Inside these portfolios, you can look at the risk factor risk of interest rates, volatility, equity, foreign exchange, and liquidity. And these all together create the composition of really what makes a portfolio work. And the third piece is you. Really the most important part of an investment portfolio is you, the investor. How you make decisions. We have spent an enormous amount of time and energy to harness decades of work to create a quantitative methodology of working with our clients to better understand how they make decisions. Why do some investors have a propensity to sell low and buy high? Why do we have this familiarity bias, meaning we invest in things we know, but don't take the time to learn about the things that we don't? And lastly, why is it that we sometimes are so overconfident in what we know, it leads us to make poor decisions? These blind spots have an impact. And we spend a lot of time working with our clients so that both of us understand that decision-making process. And when you put the three of these together, we believe that ends up in a true diversified investment portfolio. It goes well beyond this idea that one's success comes from making predictions. Instead, it comes from the idea of one needs to know how to adapt.